Hello, dear friends. Today is Friday, December 13. Let's look at the charts for the euro and the pound sterling and try to make some predictions. As we can see, the European currency's reaction to the European Central Bank's policy decision was notably volatile. The regulator lowered interest rates on its main refinancing operations and deposit facility to 3.15% and 3% respectively. According to the ECB report, this reduction is unlikely to be the last. While ECB President Christine Lagarde refrained from commenting on future monetary policy, she emphasized the need for continued support and stimulus for European economies, particularly in light of political turmoil in France and Germany. She expressed hope that the situation would improve after next year's elections. Economists and traders now anticipate that weak economic performance in the Eurozone will inevitably influence inflation rates, leading the ECB to continue cutting interest rates in January, March, and possibly through mid-next year. As borrowing costs decline, this is expected to pressure the euro while stimulating economic activity in the region, while is a key concern for European policymakers. Yesterday, traders also digested U.S. economic data. In particular, the Producer Price Index increased by 0.4% month-on-month and 3% year-on-year in November, surpassing analyst expectations. This suggests that the Federal Reserve is likely to adopt a cautious stance after cutting interest rates at its December meeting, which could drive increased demand for the dollar. Thus, the possibility of the euro reaching parity with the greenback, once predicted just a month ago, remains a credible scenario. This gloomy outlook may materialize next year, especially given the significant divergence in monetary policies between the Fed and the ECB. As for the British pound, it also suffered heavy losses. Despite buyers' attempts to protect 1.2715, the lower border of the sideways range, sterling saw a major sell-off. Before diving into the technical analysis, let's take a look at today's macroeconomic calendar, which is packed with the key data releases. Among them is the UK GDP growth report for October, including data on UK GDP growth for October. The UK economy is expected to have grown by just 0.1% month-on-month following a 0.1% contraction in September. On a quarterly basis, GDP is forecast to have increased by 0.1% in the 3 months to October compared to the previous 3-month period. These figures indicate sluggish economic performance. While the Bank of England faces the challenge of tackling persistent inflation, it also needs to stimulate growth, which make its policy decision set to be announced next week particularly difficult. Also, the UK is set to release data on industrial production and trade balance. If the reports come in mostly positive, the British pound could see a recovery. In case of disappointing data, sterling is likely to extend losses. In addition, today's calendar includes consumer price data from France and Spain, along with industrial production figures for the Eurozone. Economists are forecasting a significant annual decline in Eurozone industrial production, with no change on a monthly basis. As for US statistics, traders may take notice of import prices. Despite a light economic calendar in the US, the dollar is expected to gain value, supported by weak statistics from the UK and the Eurozone. Now, let's move on to technical analysis. According to the 1-hour EUR USD chart, a false breakout at the 1.0458 support level will generate a buy signal, with the euro rising to 0.484, driven by upbeat data from the euro area. However, bears are likely to regain control of the market in this area. A false breakout at this level will make it possible to go short in anticipation of a return to 1.0458. If the price breaks through and fixes below this level, it will add to downward pressure on the euro and open the way to 0.430 and probably 0.394. At this mark, I recommend going long on a rebound to catch an intraday correction of 30-35 pips. Long positions at 1.0458 and 0.430 can only be considered on the false breakout. Alternatively, if the price rises above 0.484, going short will be relevant at 1.0510 on a false breakout or at 1.0535 on a rebound in anticipation of a 20-25 pip move. Speaking of the British currency, it is expected to resume gains around 1.2637 mark after falling on weak UK statistics. A false breakout at this level will generate a strong buy signal. If UK data turns out to be positive, the pound-dollar pair could climb to 1.2676. If the price breaks through this level and consolidates above it, the volume of long positions will increase, with sterling extending gains to 1.2717 and even 27.47. At this level, it would be wise to go short on the rebound, expecting a 25-30 pip move. Short positions at 1.2717 and 26.76 can only be opened on a false breakout. In a bear case scenario, if the price breaks below 26.37, the British pound is likely to dip to 1.2600. At this mark, I recommend going long on rebound, expecting a recovery of 25-30 pips. Good luck to all, and have a great weekend.